lots and lots of money with advisors, and they never outperformed the market. I was a net negative. Hey there, welcome to the Guaranteed Retirement Guy Show. My name is John Stevenson, and today we're going to be talking about doubling your money with an annuity.
Well, that's too good to be true. Annuities are not growth products, John.
Yes, I know, they're not usually, but there are some decent growth opportunities available. Maybe they're not as good as the stock market, but they still protect you against market risk. And so I wanted to talk about one particularly, Delaware Life. Delaware Life, they've got a 60% participation rate with the S&P index. They are known to keep a high participation rate in that index. And because of that, when you put your money into that, you have a decent growth rate. And so, for instance, $500,000 going into that over 10 years, as long as the S&P does what it continues to do, then you're projected to grow to $1.2 million in total account balance. And during the years when the market's down, you don't experience any of the losses whatsoever because you're not actually in the stock market, okay? And neither is the insurance company. They're buying call options with the S&P index, and they only exercise them when the market experiences a gain. So it's great. Works out very, very well when you're looking for market protection and growth. Now, it's not going to be as much as if you put it straight in the index, of course, but you're also not going to have to worry about going through those years when the market is down and you're just frustrated. Okay, no one likes that. And so especially during your retirement years, no one likes to do that. You can also put your money in a MYGA contract over the same 10-year period. I want to say you can get like 5.45, 5.5, depending on the carrier. But I want to say the approximate balance at the end of 10 years is around $860,000. So it's not bad, but it's $400,000 less than what you could get with a fixed indexed annuity. So you might be thinking, oh, John, fixed indexed annuities, they're not great. I've heard a lot of bad things about them. Well, so have I. And I've seen some bad ones too. And I'll tell you, the reason why is just because they buy the wrong product. The advisor doesn't know what they're talking about. A lot of times they'll put them in an index that's brand new, that hasn't been tested. It's only been back tested, and it hasn't actually gone through real world growth and market slippage and orders not being filled, and there's just a lot of indexes that don't pan out when you're looking at an algorithm and you're thinking, well, I hope it works. I hope the market does what it did in the past, exactly like this, and it never does. And so if you're going to choose an index that's tried and true, like NASDAQ or S&P 500 or PIMCO. Any of those, okay? They're tried and true, and they've been doing very, very well. I watched these balances grow from these accounts, and it's real growth, and it's good growth. So you just have to make sure you set up with the right one. Typically, you want to also do a 1-year participation rate, 1 year point to point with a cap or a participation rate. Don't do a 3-year or a 5-year. If you do that, the market might go up for a few years and then drop, and then you don't have any growth whatsoever over a longer period of time. In my opinion, if you got 5 years in an index annuity and you've got 3.5 years of growth, I'd rather get that than none. Okay, so that's really, really important. So, anyways, there's a cabin here, old cabin, 100 years old, more than 100 years old, that was owned by a rancher here in Hope Valley. And anyways, you can see what's left. Very little of it is left, but it's still kind of cool to come out here and see it. And I love history, so it's a lot of fun to see it. But here, I'll show you around a little bit. So Hope Valley, beyond those trees, it starts to open up a lot. It's beautiful. Just a lot. And in a couple of months, it's going to be, not even a couple of months, probably a couple of weeks, it's going to be super green and grassy everywhere. It's a cool place to be. Anyways, I want to come out here and just kind of show you around a little bit and talk about just the options you have. And there's lots of people that want it, lots of advisors that want to take it and charge you a fee. And maybe they'll perform, maybe they won't. And of course, in my opinion, you probably heard it several times in lots of my videos. If you're gonna, most hedge fund managers can't outperform the market. Most advisors can't outperform the market. And so why pay them a fee? Why not just throw it into an S&P 500 index fund and just leave it? I mean, that's what I do. I tell you, I put money with advisors, lots and lots of money with advisors, and they never outperform the market. I had one where the market went up and they went down, and I had to pay them a fee. So I was a net negative. And it was ridiculous. And the market had gone up during that whole time. And all I had to do was just throw it in an index. I was just like, why would I pay you? So the same goes with annuities. If you're going to pay a fee, you better be getting something for it. So with an income rider, you pay a fee, but you're getting a whole lot of income for it. And you don't have to pay the fee, but the income, you might be paying $100,000 in fees to get another $600,000 in income. So in my opinion, if you're a net positive is $500,000 for the fee, all right, I know what I'm getting for it. That's definitely worth it. But you need to know what you're getting for it. So anyways, there's lots of things you can do with annuities. You can get growth. If you set it up with the right company, you set it up with the right index especially, and with a company that has a high renewal rate, that's not going to lower the participation rate right after the first 12 months. That's important too. Okay, there are only a few companies that will be consistent as far as those renewal rates. And we can talk about that. If you want to book a call, we can chat about that. Anyways, those are real world examples. People do have decent growth in these products, but you have to set them up right, and you have to set up with someone who knows what they're doing. So there's a lot of advisors out there that are good at managing your money in the market, but maybe not so good at annuities. Most of them aren't. Most of them don't know much about it, or if they do, it's only about 1 or 2 products, and that's it. In any case, you should work with someone who's a fiduciary and who knows the ins and outs of hundreds of products, so that they can really give you the best. So anyways, don't take my word for it. If you want to go to my website, check out annuity payouts right there. If you're looking for lifetime income, if you're looking at MIGAs, you can go there. If you want to look at it, just growth, fixed index annuities, you're gonna have to book a call, because there's a lot to talk about on there, and I don't have the software to do illustrations right there on the website. So anyways, do go to my website, johnstevenson.com. If you want to book a call, there's a link there. There's a link below this video if you want to book a call, and happy to help you. So happy to answer your questions. And if you're looking to buy an annuity, I'd love to help you. Anyways, I'm not going to try to hard pressure sells you. I don't like that. And I just want to be able to at least answer the questions you got. And of course, if you're looking to purchase, I'd love to help you with that too. So, and again, thanks for watching. I appreciate you. Hope you like, subscribe, share the video, comment below if you have questions, and we'll see you next time. Hey, I really appreciate you watching the video today. If any of it makes sense to you, or if you found value, or if you even got a question about anything, I hope that you'll go to the comments section and ask it. There's no stupid question, and I'm looking forward to hearing from you.